Hey everybody, happy Wednesday, July 22nd, 2026. Thank you, God, for waking us up this morning and giving us another day of life. Thank you, Jesus, that we can see, hear, taste, touch, and smell. Let's rejoice in the life that God created for today. To God goes all the glory and the honor. Just keep a pure heart, pure mind, refresh our soul, refresh our thoughts. In your name, amen. This is a triple post day to day. This is chapter 3 and 4 of the Breakout and Pullback by Michael Norman. The notes that I took that I felt were important. He starts off chapter 3 with support, resistance, and the pullback. So there's a space between support and resistance. We don't want to be trading in between here as breakout traders. Practically, on your 5-minute chart, this may come up as 3 or 4 candles before a breakout, after a breakout. If you're a longer term trader, this may appear just like this picture, the space between support and resistance. We're not really interested in that space. The reason we're not interested is because it doesn't present a lot of opportunity for us, a lot of movement for us to in either direction. If you're bullish or bearish, the way you make money is by price movement. There's usually not a lot of price movement here. This is pricing existing in a zone, and this is where there's efficiency between the buyers and the sellers. There's an equilibrium. We want to get involved when there's in equilibrium, or where the buyers and sellers are trying to figure out a more efficient zone to play in. So they play in the zone, then they move up, move down to a different zone. We want to find the next zone. We want to find the time before liftoff to the next zone, because it's going to take them all the way to the next zone. You trade the edges of the range, not the middle. Either the support becoming resistance or resistance becoming support. So to find mini setups, you're going to zoom into subzones inside of a larger time frame. So for us and our purposes as momentum scalpers, we trade on the I trade on the 5-minute to execute. I use the 15-minute for context, but the daily chart will give us our big areas that it will want to find another place to consolidate in. So you use those as your target areas, and then use the 5-minute to break out within many ranges before that. So this is a fundamental principle of trading and the breakout. A broken resistance becomes new support, and a broken support becomes new resistance. So what does that mean? So when a level is created and its resistance, if it gets torn through, that resistance will then turn into support if the buyers are aggressive enough. The same with the opposite. Bulls buy the retest of old resistance. So a resistance that is broken through, buyers will buy that retest. So it'll break through, it'll come down. That's the retest. When it comes down to test again, that area, bears sell the retest of old support. And a lot of this chapter is the pullback specifically, and why the pullback is so good. Spotting the shift on the higher time frame, it was what gives you context to get involved. So higher time frame, the higher time frame will give you, what this means is, sorry, this isn't really an efficient way of explaining this, but there on the higher time frame there may be a break of a key level. So for the daily, for example, I have key levels like the 50 moving average, the 100 moving average, the 150 moving average. Those are key levels that those key levels on the daily get broken, this is a shift. Now we're shifting. We're changing hands from sellers to buyers or buyers to sellers aggressively. It's notable because it's on a higher time frame, aka the daily, and that's what gives us context to get involved. So not every level is a flat line. So up to this point, we've been talking about support and resistance being horizontal lines. You can actually have support and resistance being dynamic. What does dynamic mean? That's just a fancy word for moving. Dynamic is something characterized by constant change, activity, or forceful energy. So the reason he uses these words, dynamic resistance, dynamic support, is because the line itself is being made by the constant movement of the price. So here, we're creating these lines by tracking the lows, the swing lows. So if you look closely, that line, the yellow line, is following all the lows. So that's changing as the graph continues to move. But there is a line you can draw that connects all of them. It's not going to be perfect, but you can create one. There's also dynamic resistance, which is the red line, as you see, which you will find also on the top, on the upper level, the highs of the chart. So those can also be used as support and resistance. So here he says support and resistance aren't always a flat line. Trend lines create dynamic support and resistance, moving support and resistance that rise or fall with the trend. So depending on the trend, price usually bounces off of these channels the same way it bounces off of a flat zone. So we can treat these as support and resistance that when it touches, we can expect for it to bounce off and go to the other line. But we want to catch it as breakout traders when it's moving through the line. A higher time frame reversal is your green light. So a bearish downtrend followed by a double bottom, followed by a new high that holds the higher low. So this is how a reversal looks like on the 1 hour chart. Okay. The 1 hour chart is really important because I use the 5 minute, the 15 minute, the 1 hour, and the daily. The daily is going to give us our horizontal support and resistance line. But the 1 hour is going to provide the subtle cue that there may be a trend shift. And this is what he's saying. This is how the reversal looks like in a 1 hour chart. And what does that look like? The first candle, we had a long upper wick going down, closing at its low. Then we had a normal bearish candle. And then what's interesting is that now we had a bullish candle with the low of it being the same level as the previous low. That's called a double bottom. And then we have the next candle, which is creating a new high and trying to reach for the new high, but he's getting rejected down and closing at a high. So 2 times the sellers try to take it below a point, gets rejected, and then the buyers follow through with movement to the upside, meaning it's showing that the buyers behaviorally want to take it to another level. So the 1 hour chart will give you an indication or a signal or a nudge to get involved. Hey, take a look at me. This is getting where we may be shifting from sellers to buyers. And that's where, as a bullish trader, you want to get involved. Zoom into the 1 hour chart, show exactly how the reversal forms. So the pullback, what is a pullback? A pullback is when we're talking from bullish perspective, aka price is moving up and up and up. It's when price comes down a little bit before moving back up again. So the nature of price action in the markets, it's a wave. price doesn't just move up in one vertical line directly. It goes up, down, up, down, up, down. That's just the nature of the market. The same way that you wake up in the morning, and the same way that the tree, and the same way that the squirrel goes and finds a nut, the same way that the zebra is black and white. It's the same way that when you jump, you fall into the ground. It's nature. It is just how this thing works. It's the same reason that the elephant has a trunk. There's just nothing else to explain it other than it is. It goes up and down, up and down, up and down. That's the nature of the market. That's a fundamental rule. So what is the pullback? The pullback is when it goes down. It's pulling back. A great place to enter a trade is on that pullback. That's what I do. That's what momentum traders do in most cases to make profit, is to find an area after we made a new high and pulled back into a zone. Then we get involved because we know where this price can potentially go. So the pullback exists, like in this picture. He says, I'm a pullback and I exist to give you low risk trading opportunities. I'm your friend. And why is it low risk? Why don't you just get in at the part where it's going up? Because when you get in at the part where it's going up, you don't know how far down it can go after you get in. And remember, the main thing of trading is to keep your losses low. How do you keep your losses low if you don't know how low the thing's going to go? You have no control over how low it's going to go. In a pullback, it's already going low, and for some reason it's not going lower. And at that point where it stops to go lower, you ask, why doesn't it go lower? It's because there's no more sellers there. So if there's no more sellers, that may be a good way or a good area to get involved, because if I want to buy here, there's no sellers to take this down anymore. I probably have a higher chance of this thing going up. So he says here, I'm the pullback and I exist to give you low risk trading opportunities. I'm your friend. So the pullback is the entry, not the breakout. That's the title of this. You want to get in after. So entering right at the breakout is excessively dangerous. The pullback to the broken level offers a low risk entry instead, which the whole name of the game is to have low risk trades that minimize our losses, minimize our risk, and maximize our rewards. A pullback can be a one bar or reversal, multiple bars. It depends on the time frame you're trading. So now the Michael Norman, the author, gets into a conversation about the psychology of different parts of a trade. He's laying out in general what emotions people are going through while they're trading the market. And this is something I want to go into depth on another video, but you want to know in this game who you're playing against. You have normal people like you and me trading. You also have banks like Wells Fargo and Capital One and Chase trading. You've got funds and hedge funds on Wall Street trading. You've got little companies of 50 people trading. You've got AIs and algorithms trading. These are all the people in the market that either they're taking your money or you're taking theirs. Because if you're buying, somebody's selling. And if somebody's selling, and if you're selling, somebody's buying. There's always somebody else on the other side of the transaction, and it's a win-lose. Either they made money and now they're done and you're about to lose money because the thing's not going up anymore, or they lost money and they're out just before it's going up and you make money. Our goal is to be on the right side of that equation. Typically, what that means is actually not typically. What that means is aligning with the smart money, the smart money of the we call it smart money institutions. The institutions are the ones that drive price movement. It's not me and you. It's it's institutions. It's big banks. They're the ones moving the market. We just tag along with them. I love I love this. So shoot, trying to pull this up, guys. Nope. All right, remora fish. We're remora fish. You see this shark? That's the big institution. They're the one moving the market. We're the little fish, remora fish, that we tag along with them and we ride the movement up with them. Doesn't matter where they go. And I'm not really asking why. We're asking when. We're not asking why. We don't care why. The point is they're moving it. And so we're the little remora fish that are just trying to get underneath that shark to join them. We're not asking why. I don't care why. The point is we're going with them. So retail traders are entering out of greed. Okay, so back to this, just to transition. The reason I talk about that is because in context, this is the psychology of a normal human being like you and I, the ones that need to make decisions and have emotions. That is our weakness in this game because the people we're playing against, computers, don't have emotions. And the sharks who are moving the price action, they're going to make money either way. So you and me have to manage our emotions. If we become as logical and as methodological as them, we'll make money with them. So retail trader is just a name for retail means a person like me and you. It's just somebody that I don't know why they use that word. Retail sells products directly to the customer as of buying them from a wholesaler or manufacturer. So think of the institutions as the wholesalers and manufacturers. We're the retailer. A retail is a business model involving selling products directly to customers. We are the customers because we're buying or selling something. So retail traders enter out of greed and exit out of panic. So what happens? He's laying out the emotions of a trader. What happens when you see something moving up? You get excited. You see, oh, people are making money right now. I want to make money, so you buy. That's greed. Why do we exit? Because we don't want to lose our money. So you started to see it go down. You don't want it to go down anymore, so you exit. Or you go up and you're like, oh, I made a little money. I want to protect it. Then you get out. Institutions can't exit large orders all at once without moving the market, so they accumulate and distribute gradually. This is saying that there's a hidden process that the institutions are doing that they're buying a lot, the institutions. Let's call them Wells Fargo. Wells Fargo is buying a bunch of this stock all at once. Not all at once. I'm sorry. They can't buy it all at once because for the amount that they buy, they will literally raise the price. So they accumulate, they buy, and they sell gradually over time. And so there's cues of them doing this on the graph that I will address in another book. But it's really how to identify smart money candles in the market. The professional move is to enter once that panic subsides after the well planned low risk entry appears. Chapter 4 is trading the gap. 1 second, guys. All right, I'm back. I went on a tangent to recognize or define all of the books that have to do with smart money. There's about 3 or 4 of them that really go in depth about what smart money is doing, and it'd probably be good to do reviews on that and to go in depth. So lastly, so chapter 4 is about trading the gap. A gap is when a price will open at a different point that it closed in the previous candle. So candle closes. Normally, the candle is supposed to open right at that point, but a gap is when it opens either above or below that point. There's this like physical space. So here you can see right here, right? There's a physical space that was left. This is because there's an imbalance between supply and demand. And this can either happen in a downtrend or an uptrend. There's opportunity for us as buyers to know when to. So I'm just going to focus on the buying. In an uptrend, gaps toward demand are buying cues. So if we gap up in price after a support, let's say we get a breakthrough, right? And then we gap up. A low risk long trade is that area of the gap. That area of the gap will now become a rejection level or an area of support to buy from if it gaps up into resistance, low risk to go long. So here it gapped up in price, wait for the pullback at support, then you get in. A gap down into an area of support is also a place to get in. So if we gap down into support, especially on low volume that happens at halts, get in. If we gap up after a breakout and then pull back, buy that pullback. So key takeaway from this is to trade the retest, not the impulse. Yeah, if you had to learn anything here is we're learning about the pullback after the breakout. Get involved on that pullback because that's going to show support. And if we have support, we have a low risk trade and we have room to go to the up. All right, y'all. God bless you. Have a good night. Bye.